Okay, today is Wednesday, 21st of 2017. This video is just going to be a very in-detail technical analysis how-to video explanation. So basically I'm just going to teach you what I know about technical analysis. I've got another video that came out on this date. It's a very long video. It goes into several areas. So if you're really into this, I highly recommend getting into it. Maybe breaking it up into multiple days or whatever you need to do. But this one I just want to really focus on the charts. The other one talks about the DOMs and the heat maps and the market profiles or volume profiles, deltas, the crowd, how they're really thinking, strategies that can happen by the big traders on the other side of this thing. Okay. But basically I'm just going to give you a what you see right here on the screen, education about what are the candle bars, what is the volume, what are these indicators. I don't use a lot of indicators. I actually used to use more, then I kind of got out of it because they were lying to me. And basically here's the thing: information creates mood, right? And so your mood usually determines how are you going to do things. So when you're dealing with risk, right, if information is telling you that things are less risky, but in fact they are not, they're no less or no more risky than before, then it decreases your chances of being accurate. And so the reason why a lot of traders start out with a lot of data, a lot of information with all the different indicators. I see some guys that they have so many indicators, and I know some of them, they actually have a legitimate reason for all of them. They got different kinds of charts and so forth. And then I see some with very few, and basically it's just how they just want to know, what's the crowd doing. That's it. It's kind of like having a squawk box, right? What a squawk box is basically they put a microphone down in the trading pits. And so, you could hear the action down there from up in the office or wherever. You can get squawk boxes. But if you ever hear the show on CNBC is called Squawk Box or Squawk on the Street. There's other kinds of shows like that. Hold on. And so you hear the squawk name around, and that's where it comes from, is that squawk box. So if you're an institution and you're upstairs or in a different building or however you set yourself up across the city or across the world even, if you can get that racket out of the pit, then that can give you an advantage. You know what the crowd is doing, and therefore you can call in. You can say, okay, I hear what's going on, I'm going to call in this order, etc., etc. Or I can hear what's going on, so I don't even dare put in this order. I'll wait until, etc., etc. Well, what's the next best thing is actually being on the floor right there with them and actually hearing the crowd, actually knowing when the institutions are stepping into the market, because you can actually see their brokers that represent those institutions, like the big banks, etc. So you already know what the crowd's doing, therefore you can trade per that data. Now we're out here at a distance and we get this instant data, and most of the markets on the computers, very small percentage. Most of the pits closed down. They're really small compared to before. And yeah, you can still go in there. The thing about going in there is the seat, you got to pay to get down there. You got to rent it. Can be expensive, but at the same time, your trading costs are a lot cheaper. All your trading costs are cheaper. So, if you know what you're doing, you go down there, you make a lot more money. and also you're in the crowd, so it kind of helps. It can also be fun. I was thinking about doing it someday, just for 6 months. But out here, we've got our own crowd, and the majority of the crowd is out here. Actually, the majority of the crowd is a computer, but the computers that do the trading. But as long as the humans are, on the wheel, which is normal hours, normal trading hours in the good markets, the ones with liquidity, then they kind of control the show. They basically control the show. If you got liquidity, it's people saying, okay, we want to get off here at this stop, and then we want to go further to the next stop, and then we want to, and it's all just like bus stops. You know where you're going to stop. Okay? But when there's not liquidity, there's not a lot of people in control, so the robots, they just kind of take over control. And basically, it becomes helter-skelter, illiquid hell. And basically, it's like having, this AI robot driving your bus, and it's driving through the intersections, cross traffic, it's headed straight into traffic, it's passing bus stops, it's dropping off people, wherever, just whenever. Right? And then it's driving off the bridges and stuff like that, driving off the bridges. So it can not be what you expect. And that is the purpose of these algorithms, is to do the unexpected. You see, so if you let them drive, then they'll do the unexpected. And I mean, that's just market trading. But if you've got people actually trading these things and they're alive and they are actually reading charts and that kind of thing, right? So then they have their hands on the wheel. And so basically what the computers become is they become power steering. Okay? So that when the traders out here, they're reading the charts, most of the time there's not going to be like a real big breakup in the other direction. It depends. It really depends on the institutions, right? So if the institutions want to start, getting out of the market real fast, or they got to get into the market real fast, and it's a lot of them, and there's a ton of money to go, they might do things unexpectedly, but most of the time, in the liquid parts of the day, they go along with the market as well, okay? And so then basically, it's like power steering. So we kind of get together, the crowd, we read the charts, we see what's going on, and then we make our decisions based on that. So these are rational decisions. We're also backed up, so it's not like we're going to get all spun out and everything for making a wrong decision. Okay. And these are big players. These aren't $30,000, $100,000 players. These are multi-million-dollar players. Okay, and they're all over the place. They're stacked up on floors in Chicago and New York or wherever. They're running big computer systems up there in the lofts around the exchanges in New York City and Chicago and so forth and so on. So there's a lot of power behind it, and then once we start to drive, you know how it is when you got power steering, right? Have you ever driven a vehicle without power steering? It's a muscular exercise. You actually have to recalibrate all of your steering angles and the sense of the road, anticipating turns, yada yada yada, and be able to not react to things that don't need to be reacted to and that kind of thing. It's just a lot tougher without power steering. And the thing is, though, is once you put that power steering mechanism on there, then when you turn the steering wheel just a little bit, suddenly it just gives you that ease, right? So you don't have to just rock the thing. You can just ease into it, and it does the rocking for you. And so that's what these electronic markets are like. As long as the humans are driving, then they become like power steering. So when we start to turn, because the shape of the charts and the indicators are looking a certain way, then they will just turn the rest of the way for us. They read what we're doing, and so in anticipating what we're doing, they augment the they augment that behavior, and then in their augmentation, we know that they're going to augment the behavior, so we get on back of them, and then they get on back of what we're doing. And so, it just exponentially becomes that much more powerful. And so to go against it, you really have to put up a really big, powerful program to go against it. Otherwise, basically everybody's just going to read it and go with it. They're not interested in going against it. And so for you as a new trader, you basically want to be able to read where are the bus stops, right? Where are these turns, and where do I get on? Where do I get off? Right? You got to have both points of view correct. Excuse me, I'm taking a drink of coffee. Okay, this ain't the greatest chart. There's not a lot to talk about here. I talked about it in that other video I made today, which was the long one. But for the most part, I can go back through this real quick. I got a economic report here about inventory on the oil. This is the oil market. It's CL, light sweet crude oil futures, August 17. That's the contract month. So we got a bull out of the out of the gates here. Runs up, rockets back down. We got a bear out of the gate here. Runs down, runs back up. Pretty 50-50. These 3 bars here, anytime you get an economic report or the market opens up, those first 3 bars are not telling you anything. Okay? And then we've got a channel here. We've got a range, which means that you've got a resistance line up here. You've got a support line up here. And price does not violate those resistance lines and support lines. No violation, range. Then we break out of the range, head it on down, right? So there's your indication. This is looking bearish. And not only that, this is a really big bear bar. Look at all this volume down here. Okay, so it means that this bar, which is 40 cents, which is a pretty good sized bar, was loaded with a lot of volume, far more than the average volume bar out here. Probably 3 times more or 4. And the thing is, though, there's a lot of bulls in there as well, because the thing is stacked up so high and that bar is not so long. And therefore, that there was a lot of bullishness there. And because it was a solid bear bar, that there's a ton of bearishness there, right? So because there's more bullishness right there, it took that much more bearishness to drag price all the way down here against whatever they were thinking. Okay. And then it just stepped off, right? So basically the bears were going to wait. They were going to wait, see if price comes back up here. And if it does, see, they were basically, fellas that get, if they got to liquidate big positions for the clients, they get a bonus for liquidating on, if they're selling, they want to be north of the VWAP line. That's what this is. I don't use this line or this line, these 2 outside lines. I just use the center line. So if they're liquidating positions for their bosses, and then the bosses put those positions on those traders for the clients, okay, they're probably pretty big positions. They want them to work out the best prices that they possibly can, and then those traders, they get bonuses for every contract or share or whatever they're doing that they can get out of north of the VWAP line. And if it's vice versa, if they've got to put on long orders, then they get bonuses for every contract or share that they get into south of the VWAP line. Okay, so we get this big sell-off here. Bears just gator-bellied over the bulls. They were there. That's why you have so much volume here. That's why this bar, this price bar, is not all the way down to here, right? If there was no bulls there, then this price bar would be down to here, with that much volume. That's what I'm saying. There's a lot of volume right there. So there was a lot of bears, but they still were gator-bellied there was a lot of bulls, and those bulls were gator bellied by the bears, obviously, and they got 40 cents. Now the thing is, though, is that what are we doing right here? We are waiting. We're waiting for price to go back up here above the VWAP. Well, guess what? There's just not enough bulls there. They ain't gonna do it. They're just not gonna do it. So they just basically say, no more of that waiting. The price did get down to here. We did tempt some bulls. We did violate this support line, and it just was a no-go. Got back up here and then couldn't go any further. Right? Somebody picked up some longs here, and they figured, that'll pan out. We'll go back up here. I know how they are. They're probably looking for higher prices, so I'll take advantage of that. Well, it turns out it was a no-go. And so we just slump off here. Now, look at the downward trend. Okay, pretty steady. You have a long, thin range. It's like a very boring, thin range here. You can hear the Z's bzzz, just snoring away, and Z's are flying out of these. And then it starts to pitter out, it starts to go, farther into the hole. It could be vice versa. And I'll show you a chart from yesterday on the same market where it does go the other way. So basically they're just snoozing in a range, tight little range, and then off, it starts to drift. And then once there's some drift, yeah, that's when everybody gets in there. That's when folks want to, hammer down. So then we fall off here. Okay. Not such a big volume bar. In fact, this bar is about half of this bar, but the volume bar is less than half of this volume bar. So the bulls are just that much fewer there. It's a good solid candle. Okay. And so that's how I know that the bulls are not there. See, I'm reading into the bar based on the length of the solid pieces of the price bars and the length of the volume bars, and I'm comparing them, side by side. Okay? How long was this compared to this bar? Half. Well, how long was this volume bar compared to this volume bar? This one's less than half. So that means that there was less bears. How far would this price be down here if there wasn't really any bulls in there? It would be 2 or 3 times further down on price. All right. Now, so less bulls doesn't take as long to fall off again. And Viola, we violate support right here. So then it's off to the races. Now, there are some stops here. That's what's going on. There's stops down here. Where they hit those stops, it hits the volume. So basically, probably bulls are getting their buy orders hit. Bears are getting their buy orders hit because they got to buy to cover to get out of their short positions. All right. Now get into the short positions. Bears are getting their short positions triggered, so they're getting in. Bulls are getting their orders triggered to get out because now they're the price is going against them. All right. So once that volume hits, boom, it gets all kinds of more volume, right? So if I'm watching this, right, and I see that violation, what am I going to do? Well, I'm going to join the party, and I'm going to add more gas. When everybody does that, they all add gas to the fire. And then what do the computers do? They got specialty programs that add even more gas, and that's where that power steering comes in. So, and then they're front running, hundreds of millions of dollars at a time per company, many times per second. They can do that, 400 times per second in and out because they're so fast. They can guarantee themselves a little bit of money each time, but it's guaranteed money, and so it's just drawing it down, and the higher the volume and the higher the bear ratio and the volume that's bearish delta, then they're going to hold on to those short positions longer before they let go to whoever else is selling, right? Because they think that they can hold on to it longer. And so it adds more weight and it just falls down that much further. And as you can see, the volume sticks right up, you know. And what is the volume here? It's practically the same as this volume over here. The length of the bar, it's 40 cents again, 40 cents over here, same. Okay. What is that saying? It's saying that there's still a bunch of bulls in there, but the bears are definitely having to use the biggest gator bellies possible to keep them down. And then it's the same thing here. You've got almost the same volume, and you've got even a shorter bar, you know? So you're more sure about the content of bears in there, right? And bulls, right? You're actually seeing more bulls in here because basically if you're equal, like the ratio, the delta is equal, the bar is going to be flat. Like this one right here, basically flat. It opened and closed at the same place. These ones are almost flat. It didn't move very much. But the volume bars are fairly shallow. This is a deep volume bar. This is, you know, this isn't moving very much. It is it is at least 20 cents, maybe 24 cents with the wicks included. Okay, but the volume was just trinormous. And it's still saying that the bears are really hammering here, but they're fighting a lot of bulls, but there's just so many bears there versus the bulls that they're winning. Therefore, you know, obviously you got to give them that much more credit and go along with them. Now the volume starts dropping off here, so I'm thinking that, right, the bears are giving up, right? Bears want, basically when they see this much volume, they want bars to be dropping, flying down, right? And also they can read the ratios. Okay, those computers can read ratios. People can see, you know, we can translate what all this stuff means. And so it's not looking very bearish. So, you know, we'll move on. We'll look for what's next. And also you've got this quick tail right here. Well, what that quick tail means is that price ran down there and then it ran back up. Okay. You know, in a slow, melancholy market, you get solid bars like this solid bar, this solid bar. You don't have wicks and tails sticking out anywhere. Okay, but wherever there's panic, greed, any kind of sentiment that basically says, hey, you know what? This is probably the bottom, or this is probably the top. Then basically what happens is you get greed here and they start looking for higher prices, or they're just taking profits, and more than likely they're taking profits. And that's something you gotta keep in mind. As market moves, people have made money. Obviously bears are making money here. Okay, so they're taking profits, right? That's what this means. Boom, boom. You know, and a lot of this volume here, you got to consider they just made a ton of profit. You have to understand that every 10 ticks on this oil chart is worth $100 per contract. Now look at that. Always consider that. You know, when you're trading, figure out, okay, well, how much is a contract worth per tick? And then look at it like, you know, 10 ticks and 20 ticks, and just put everything into perspective as far as handles. How much are those worth? Well, from up here, you know, down to here, it's like, let's say 20, 40, 60, 80, 100, 120, 140 ticks down here. You know, 140 times 100, well, that's, what's that, 14,000. So, you know, per contract. So somebody's taking profits here, and you can see that. That's what a lot of this is. By the time you get down here, you know, it's like, even me, I'm taking profits right up here. I don't need the full ride. I will invest in some of this. I'll do what I do. I've got backwards and forward strategies, so it doesn't matter which way I'm going. But then, I would, ordinarily conservative traders just take some right here. We don't need the full extension. I don't need to go all the way down here. I don't need to go all the way down here. There are traders, though, that take the full ride and they wait until they see this. When they see this, okay? Or maybe this down here. This is a signal, too. Okay? They'll actually hold on from all the way up here down to here. They've been in for so long, I don't know what's in them. But, maybe after I'm in it for 30 years, I'll know. But in the meantime, I'd take what I have and then not give it up. Because a lot of times, and I'm not talking to them, they're the pros. I'm talking to you, and if you're listening to this, you're new. And what you'll see a lot of times is you'll have money, you'll have fish in the basket, and then the fish leave the basket. You've got to figure out a strategy for capturing the fish and eliminate the risk, and stack up for a bad trade, because you got to have your drawdown be enough that you can suffer a bad trade once in a while, and it won't sprain your operation. Okay, so basically, I got fish in the basket right here. This thing right here is worth 40 cents. Like I said, that right there, that move right there is 200 a contract. Okay. Well, I'm good with 50 a contract. I don't care, or 100. I'll take that. It depends on how fast it is. Okay. If the sucker moves down there fast, and it moves 10 points fast, right? That's probably about where I'm going to take it. And then if it starts telling me, hey, we're looking back up here. We'll start taking profits. Well, I don't want to hear any more news. I'm out. I'm looking for the next trade. I'll set up the next trade. Okay? So I'm going to guarantee that. Now, if it runs back at me, then I can set up even higher or whatever. And if I'm working two strays on both sides, I've got a short one and I've got a long one there. So one is seeing profits, the other is seeing losses. So I'm gonna add to the one that's seeing losses at lower prices. The other one that's seeing profits, I'm going to jump out with it, and then I'm going to see if I can't work another piece. What I'll do is, if I jump out right here but price is going to continue, well, then it's going to hit my my short trigger. Okay, and that short trigger will put me in a short, and so I'll be wearing shorts all the way down until I take profits again. Now if it wants to keep on going, then it's got to trigger the shorts. Okay, so once the shorts are triggered, all right, then I'm putting up on the table there until they show me otherwise that I don't need to do that anymore. And that's what I see down here. I'm seeing this wick, right? You can see that wick. I'll uncover it there. That's a quick tail right there. It just means once you got down here, people were taking profits. You can see they're taking profits here. Okay, so that's how you read the candlestick charts, the volume, and that kind of thing. Now, when I get over here, you got this big, this big roar right here that comes out. That's that volume coming out there. You're not seeing much movement right here. The volume's bigger than normal. I mean, this is extraordinary, but this volume compared to all the other volume here is particularly interesting. So the thing barely moves. What is that? 10 ticks, maybe, about 10 ticks, and like 5 of the ticks are a quick tail. Okay, barely moves, but we've got a significant volume bar here. So that's telling me that price is barely moving, but the volume bar is significant. It's at the bottom of the chart. It's at a time of day, when people start leaving the market, and anything that happens in the market exacerbates itself. It happens exponentially. So if people start leaving the market, that just means that they're not going to be bullish or bearish either way, right? And if the market's already run down far past the 34 exponential moving average, that's the money line or the harmony line. That's my line. You won't see that anywhere else. It's quite a ways down there, though, right? Well, at some point they got to take profits, and where volume starts to peter off. Now, this is heavy volume. We're a ways down there. We've been a ways down there. away from the money line for quite a long time, things got to come back. That's just how it works. And they're running out of volume, right? So right here was a train. I mean, you had train power. It was just, you couldn't fight this. They were trying to fight this. Doesn't matter. Take profits or buy along. It didn't matter. You know, bears were belly surfing over everything here. And then they got, you know, this is where they took the profits here. And then it just kind of, volume kind of petered out. And then you see, like, it tried to sell lower. Yeah, okay, let's try to slam these bids and crush this price down. No, there's just not enough there. And you know what? It's about that time. So we're not going to help you out. We're not going to push you any further. We're actually going to buy this. Okay. And so you get that quick tail, it runs up, then it comes back down here again. It gives you another quick tail. Okay, so it dips down there below support. Below support, tests down there, fakes out. No, it's not happening. Now, I showed you on the other video that was done on the same day as this one that how the heat map works, and you can see the double bottom on it. It doesn't use a 5-minute chart. Like, this is a language that everybody uses, but on the 5-minute chart, the candlesticks here, but the heat map that I use as well gives me a, you know, per second, where is it going per second? And then it tells me what the volume is on all the price levels on the dome, where it was 5 minutes ago, 10 minutes ago, 11, 15, 16, doesn't matter, hours ago. Okay, so it tells me what all the depth of market was back then, per minute, per second, whatever. And it's not 5-minute bars. It's just, you know, it's a line chart. It's per second, wherever it is, that's where it was, per half second, whatever. And so I could see a double bottom on it, and it was right here, and I was like, well, that's the buying opportunity when I glanced over there. And right here, you see that basically, if price was going lower, what it would do is it would dip down here. You wouldn't get this quick tail. It would stay down here. And if it were to come back up, it would come up. It would bounce on this. This is support right here. But if it stays down here, it comes back up and it bounces on this resistance, and then it heads down. It's like a staircase. Okay, but it's not going to staircase down. It tried to go down there, but it's not. So you've got a double bottom, right, on the same support, and then it heads on up. And so I could see it on the heat map. I could see the double bottom in this bar right here. This was the bar. Inside of the bar, you see the double bottom. I knew that was a buying opportunity. I confirmed it right here. I look down here at the MACD, and what do I see? Well, I see basically between 42.40 and 42.20. Price is staying in a little range. It's 20-cent range. But what's happening on the MACD histogram? This thing is getting higher and higher, right? It's staying in a range, but the MACD is coming back over. And I see that bears couldn't belly surf over the bulls right here. They actually bucked them off right there. There just wasn't enough of them. There's just nobody in the market. Volume's falling off. I got this pivot volume bar right here, so I know what's up. They'll go ahead and test this support line. Fails. It's quick. They run back out of there. They run them back out of there, you know. So bears are getting out of the water. That's what this is all about, right? So the volume delta ratio is becoming much more bullish. The bears are disappearing. Therefore, it's like, you know, maybe bears were ahead of bulls 3-2, but now then it's getting less. So it's like, I don't know. I've been talking all day, so I'm just worn out. So basically, you get into fractions, and then the fractions just get smaller and smaller, and eventually they equal out right here. Okay, and then the ratio becomes dominated by bulls, and then it runs on up. What am I trying to tell you here? What I'm trying to tell you is you got this huge move down. You're far away from the E-money line. You've been away from it for a long time. Somebody's got to take some profits. When they start taking profits, money's got to run back up. Prices got to run back up. The market's disappearing at this time of day. So there's just not enough volume to keep pushing it out. There's a lot of short positions here they aren't going to hold short overnight. All we have to do is overpower that minimal volume and get that price to break out right here before the close, right? They're going to close their short positions and get out. Well, why don't we just force them into it? And that's what happens here. We get a little breakout here. This one is 20 cents in 10 minutes. 20-cent breakout in 10 minutes. That's $200 per contract. Okay, so this is stuff that I anticipated, and of course it just came true. Now I know that this is a matter of market mechanics. Like there's a power factor here, right? In order to get the price down to here, you had to have a lot of fuel, right? Okay, and you have to have a lot of long-term investors from institutions with hundreds of millions and billions of dollars, right, to be interested in this much volume at this time of day. Normally this doesn't happen at this time of day, but it was just one of those reports, right, that told them about how the oil market's looking, so they got to adjust accordingly. Okay, so then it actually brought in a bunch of traders here that were going to employ some more money. Okay, and you know, it's not like everybody's watching the thing. Computers keep track of this stuff. They keep track of all of this stuff at the same time. It's just that the volume brought in more volume, and so, you know, those institutions are mostly computer traders anyway. They call shots manually, but it's mostly computers. Okay, they set up the parameters. They say they want to get this done, you know, by this time under these conditions, and then if these conditions change, then by all means just dump on it or whatever, or don't even do anything, or that kind of thing. And so they're very complicated algorithms, some of them. I mean, you know, the biggest ones are probably the most complicated ones. They've got the best quantum physicists, and what do they call them? Quants. In the industry, they call them quants. They're the high-tech, most elite, you know, mathematical geniuses being paid large money to set up these systems. So the bosses just say, you know, we want this much done by this much time. These rules, they just flip the switches. Okay, computer does it for them. They just monitor it. If things are going to go out of the ordinary, then they're going to flip the script or whatever. So that's one chart. I'm hoping that, you know, you're getting the idea that there's forces involved that nobody can beat. And, you know, at certain times of day, certain forces are there. At other times of day, other forces are not there, or the same forces are not there. And, you know, it's a machine. All right. I mean, it's people. It's people and their machines. It's the mood of the investors, which is based on the economics out there. Okay. But there's just so many, you know, mechanical things that you can do, right? So you got this right here. You understand the dome. You understand what it takes to move price up. You gotta get rid of all the offers. You gotta dominate the offers, and then that moves up the price because there's too many sellers compared to the offers. So we gotta look for offers higher. If there's more sellers than the offers at that price, then we gotta look higher. It's a supply and demand thing. So supply is over here in the offers, demand's right here in the market where orders are being executed. If there's not enough supply over here in the offers, then we gotta look higher. And then that has to be weighed against the supply and demand over here. The supply of bids versus the buyers in the market. If the buyers in the market are higher than the bids in the supply over here, and that ratio is greater than the ratio of sellers to the offers on supply over here, then price will go down. Okay? Market mechanics. And you know, people got to take profits. People are losing their heinies. People are there or they are not there. Therefore, the force is that much stronger in the market, or it's not. the market's oversold or the market's overbought, therefore it's got to turn around at certain times of day. You just can't keep driving forever. There are reasons why it's got to fall back down or it's got to go back up. What happens to a market that goes up? It goes down. What happens to a market that's gone down? It goes up. It's just you got to understand why all that is. You got to understand the crowd. You got to understand the finance. You got to understand this market ticker mechanism. You got to understand volume delta ratios. You got to understand those algorithms, how that power steering works. Let me give you one more here, and this is mostly on the other one. I'll just buzz right through this. Okay. So basically, this is the advanced dome. So this is a Ninja Trader dome. You find this on every platform. Some of the platforms have this kind of dome. It's an advanced dome. It breaks down everything. So basically, I'll show you that again. The price here in the middle is right here. Okay. Now, the selling and the buying out in the market happens here between the offers and the bids, but you don't actually see them here. On here, you actually see them, and they separate them for you. Okay, and then you can see how many contracts are they pulling off the bid supply. How many did they pull? What are they trying to do? They do stuff. Okay, now I explained that in the other video. How many are they adding there? Are they trying to add more supply and beat the sellers here? What are they doing? I explained that in the other video. So you can see how many they're adding or subtracting here. You can see how many are actually in supply here. How many actual bids are there on the contract? And there's an equation here. So basically this minus this plus this. Hold on. It's something like that. I'll just keep on moving along. But it's actually a very equal, very nice and square and tidy equation here. Okay, just remember that. Think about it. Study it. I'm just going to move on. And the same is over here. Here's the offers on supply. Here's the buyers, and then you've got the pullers and the adders that are pulling and adding offers here. And then you do the same equation. It all adds up. It's very square and tidy. Pretty simple. If this number's not going up, but this number's going up, this number's probably going up, right? So they're buying it here. They're adding more. The number stays the same here on the offer, but as soon as they buy here on the out in the market, okay, then they add more to the bid. So the bid is just every time they buy one here, the bid should go down. But then over here, it shows you that they're actually adding to the bid. This is the offer. They're actually adding to the offer. Okay. And so this is going up. This is staying the same. This is going up. And if you're wondering why is this staying the same, you can see right here that that's what's happening. Now, once you figure all this stuff out, then all this stuff on this chart, these candlesticks, makes a lot more sense. And you got to think about this stuff in business terms, right? So you got to think of all these things like I've been calling them shorties and bullies, right? So if I want to buy bullies over here, right, that's what's for sale over here, then I'm looking for higher prices, right? Because I'm a candy man. I sell candies, and so I got to make profits. Now, if bullies are not selling, if bullies are not selling over here, that's probably because there's not a market for them, so I don't want to buy any bullies. So I'm going to invest in some shorties over here, right? And because prices is looking better down here. And so, I've got to make sure my inventory isn't, high on some kind of, bad lot of bullies or anything. Or I don't want to be holding a bunch of rotten shorties or anything. So, that's business. And these are the shelves. These are the shelves, right? What do we got here? We got 42.49s. And what do you want? Shorties or bullies? You got 42.48s. What do you want? Shorties or bullies? And the price is down here. Well, then you got them down here. And you can see right here, right? You got all those price levels right here. They are not selling shorties. If they were selling shorties, they'd want these, and then they would expect price to go down here. Well, you don't want to be caught with shorties right here because price is going up. Okay, they're actually buying these, right? Why? Because they're looking for higher prices out here. So it's kind of like running a shop. You gotta see what is not selling in order to figure out what is selling. Right? And that's assuming that that you buy and sell shorts and longs, which you kind of do. You know, if you think about that. All right, so the day before, what happened here? We get okay. That's a circle. I'm gonna use a support line here. Okay, so as the market, why don't I do this? So let's say price is right here. What did we get? We got market opens up, it tops out right here. That's the swing high. Okay. The opening swing high, that makes a difference. Are we going to stay above it or below it? What's the mood here? Okay. Same thing on the swing down. Is it going to stay below this? Right, are we going to come back up there and range in here, or are we going to reverse this altogether? Okay, what's the mood? So we establish resistance right here at the open. Come down, establish some support right here. Go up. We don't even go all the way up to the resistance. Why? Because whatever these prices are right here, these bullies, these candies, right, or call them shirts and shorts, whatever you are selling and buying here for people, you're the broker, right? They are not selling because nobody's going any higher. What's selling? Shorties. Why? How do you know? Because you didn't even get up to resistance. Normally, a civilized market, decent traders, they go all the way up to support, right? Then they go through it. Now that all means something. If you don't even get to it, that means that shorts are real hot, and they were. In fact, prices moved on down about 30 cents, which is pretty good. That's $300 a contract. Okay, somebody was making money there. All right. And then the bulls came in there and they hit this thing pretty hard. They added quite a bit of volume here. Now the oil market is a little bit peculiar in that the bulls might hit you real hard, but the price will keep on going down until they've hit you enough. And then finally at a certain time of day they'll take it over and they'll head back up. So these aren't really pivot prices. It's just saying that there are some bulls dropping in some big orders here. So there is some interest in the other direction. Okay. Now we've got support, and what do? We break on down. We break down, and then what do? We bounce against it on the underside. So we're hitting resistance right here. Get out. We're hitting resistance right here, and then it's bouncing off. Okay. Now this becomes this becomes support. Okay. So price is moving along. Now when I bounced right here off of this is resistance, okay, I knew I could short this and I can get a drop. And so, there's my shorties. They make money. Then I establish another step in the staircase. So I'm expecting this to come up somewhere and then go on down and then repeat the process, bounce off of this resistance here, and then I get the drop. And so if I'm bearish, I'm just trying to drop bear everything, right? While in fact, it doesn't staircase down. In fact, the thing basically bounces here, right? Here's support. It tries to break through support after it bounces off of resistance here. And then we get another bullish slam, right? So it tries to break, they don't respect support. Bears don't. They're going to head on down. Bulls counter that, slam it, says, hey, we've got some momentum going the other way. Bounces here on support, bounces here on support, bounces here on support, bounces here on support, bounces here on support. What do you think? Probably going in the other direction. Now, if we were headed on down, you wouldn't have this range. Okay? You wouldn't have this range if we were headed on down. That's just what you gotta expect, right? You've got pivots right here. This is a pivot. This is a pivot where it turns down. This is a pivot where it turns up. This is a pivot where it turns down. This is a pivot where it turns up. You got pivots that are out there away from the 34 EMA, the money line. Okay. You got nothing above the VWAP here. So whoever's filling these orders for clients, they aren't even waiting for price to get above the VWAP and then sell it again. So then it comes all the way back to the E-money line, which is basically neutral on the chart. 34 EMA is neutral, okay? And it doesn't pivot. It hangs out there, then it walks on top of it, suggesting there's some bullishness here. But at about this time, which is 2.5 hours into the day after the open here, no. That's 3 hours into the day after the open here. The market usually kind of dwindles off, and you can see that the volume slowly recedes until about this time right here. You can see that in the volume. Okay, so if we were headed down lower, what do? We come down here, we bounce off this, and then we see if we're going to head down lower. If we're going to head down lower, it would bounce through that support, not bounce through, break through it, come on down, come back up, bounce off resistance, and then head on down and try it again and again and again. And you'll just see this staircase. It's always a staircase. Very rarely is it anything else, right? So you can bet your money on that, right? So that's where your money's needed. That's how you gotta work. Now, we break through resistance right here like expected because we had a double bottom right here. We bounced on the support line. We bounced off of resistance, came back down, bounced off support again. Guess what? We're probably going over. The volume's petering off. So it's going to be real easy to overpower bears. Now we're all the way back to the E-money line, so there's not any shorts. There's not a lot of short holders here. I mean, right? So you got to have a lot of shorts that have to buy to cover in order to fuel the market up higher. And then once they start, it's bear bustion, right? They're trapped. They got to get out. They got to buy to cover. Then they got to buy long. And then all those algorithms and all those people are going to say, I'm buying too. Right? So then you just get this big short squeeze and there's just not enough supply on the offer. And so prices got to look higher and higher and higher for enough supply before it stops, and then it takes a break or it reverses, right? And so we didn't get that when it got back up here, right? There's just not enough volume. It's that time of day. We're at equilibrium. It's pretty much sleepy. And then what? And I called this one right. I knew it. This would be long, and I could hold this one the rest of the day. And sure enough, that's what it was. The thing about this, though, is that I still have to trade this defensively. I don't personally just buy and then I don't defensively trade. I always have a defensive trade on the other side of things. I've got stops, trades in the other direction. I'm reading all these bars and so forth. But on this, you can see basically you got a quick tail there, you got a double bounce. It's actually two quick tails. You can see that the bulls slammed this. It wasn't much higher than this that the bulls really hit right there. Okay, boom, boom, boom. You got this one right here. It tries to break it down at resistance, but then it doesn't work, right? And then you got this little dude right here. Okay, that's a higher low. These ticks right here, which is probably about, I don't know, 5 or 6, which is a decent amount of ticks on the CL. They were not shorting those. They weren't grabbing those shorties because no one was going this way. So that tells me that it's going to that away, and that reassures me right here that this is on. Okay, and then basically this becomes the new support. Okay, bounces off support and then walks up the EMA, and then everybody's closing out of their trades, and they go ahead and I guess they filled in their orders here and they bought more, right? And they were also buying more here, right? Maybe they were covering their shorts, I don't know. But towards the end of the day, if you gotta get in the rest of your position, you gotta throw it all in there. There's something called the MIM, M-I-M. It means market imbalance, and you can get this thing for $100 a month from Top Step Trader. He's been a broker and a trader, a pit trader down there for 30 years and other things. He does a bunch of talks, bunch of news all day, every day. He's got a Twitter channel. Go to his website there, get updated. He's got fellow traders that are just as old and experienced as him. The older they are, the more they can read these things. They know the crowd by heart. They know the world by heart. And he's got a thing. It's a mem. Basically what it does is it tells you what the imbalance is. So as we get closer to the close here, what you'll see is a huge amount of orders come on that got to be filled. And so if you've got like $500 million difference, so let's say that the bulls are $500 million over the bears at the end of the day. That's the closing orders. Okay, the depth of market is just racked. It's just filled, and there's just more volume in the dome than ever in the rest of the day, because they got to close all these things. They got to get all their orders in by the end of the day. They aren't going to get any better prices. They got to have this done by the end of the day. They got positions out there that they can't be in overnight. They just don't be in positions overnight. Market makers got to get out of there, blah, blah, blah. So you just get all kinds of volume. That's why the volume always kicks up at the end of the day. But if you got like 500 million to a billion or more bias to one side in the market, that basically what that means is that you can be rest assured that everybody else is going to be buying this thing and pushing prices up on top of all of that buying. And so a lot of times you can use that MIM to help you with your trading there. It's not guaranteed every time. They can flip the bill. Somebody can come in. Other people can duck out, right? So maybe it was over the bears, but then suddenly a bunch of bulls jump out. They're going to hold overnight, or they're just not going to get in till the next day or whatever. Yada, yada, yada. They can flip the script. So you can be wrong on that, but usually it's a pretty good indicator. If it's a huge imbalance, you know what I mean? It's not going to work every time. So if it's a small imbalance, it's just not going to work. But if it's a really big imbalance, it basically says that it's going to take the moon to crash land here in order to shake this market. So this thing's got legs. All right, so what do we got here? We got a range here. Got the opening swing low here, which we violate right here. opening swing high, I guess we'll call it that. Technically I would call this the opening swing high. It tests over that, right? Run down, hit the E-money line right here, EMA line. Runs up, ticks down fast, gets that's a quick wick. That's a quick wick right there. Bounces on the E-money line. It's walking on it. Okay, this becomes support. Doesn't even meet it. Heads up there. Gets slammed. Right? The bids get slammed up here. They're not obviously taking profits here. They're sellers. Okay. You didn't see the market move very much here. So bulls are not making a lot of money. You don't see a lot of green bars, big green bars in a row, steady, where you're seeing bulls making a lot of money. So you know it's not profit takers. What it is it's sellers. Prices got up high enough here. That's why it's bouncing right here. It's above the VWAP. So they're trying to sneak in some sell orders. It gets up here and they just knock it out. Okay. The bulls are not taking profits. It's actual sellers trying to get out of the market. And probably short sellers too. Comes back down here. Those bulls that were over here are still interested. But then you get this quick wick right here, right? Okay, starting to trend down. You got that quick right there. Then it rushes down. That's a good solid bar right there, bear bar. Okay, it's not one of these little weak and flimsy bars right here like this. This is a solid bear bar, and it finally violates, right? So now where are you? You're right back down here to the swing low. It keeps on testing it, test it. Okay, you got a lot of volume in this bar. They totally rejected the swing high up here, right? So if they're not going to stay above the swing high, and they just knock this thing down 20 cents. This is only 20 cents because these handles over here, they're 10 cents a piece. So it just knocked this thing down 20 cents in 10 minutes. 10 minutes, 20 cents. That's a pretty good move right there. And we can't get out here. We're not going any higher. Well, guess what? And so, you know, you get this little doohickey right here. See that? Same thing. They're still stuck on selling. You just can't buy anything above the last bar. Above the last bar, even though they're ranging here. Okay. And so, Viola, look at that. Close right there, close right there, close right there, close right there. Opens up, finally breaks that little resistance right there. Heads on down. We make some profit. This is a 20-cent drop. Okay, it's $100. Well, that's $200 a contract right there. Somebody's making a bunch of money. Take some profits. That's what that is. That little quick tail right there, where it runs down, then it runs back up, and then it leaves that tail behind. Somebody's taking profits. It's just ruminating in there, back and forth. I know the strategies. You know, run up the offers in the bid at the top. Run up the offers at the top. Run up the bids at the bottom. Pull the offers, let it go up. Pull the bids and let it go down. It's just controlling supply and demand on a thing and making it move. So this becomes support. Now, if the thing is moving up, then this thing is going to bounce here and move on up. That's how I know when it's done. But if it's not moving back up, then basically what it's doing is, and this becomes support right here. Use the lows from before. Okay, so run up, bounce off of, no, this becomes resistance. I'm sorry. If you know the difference between support and resistance, good for you. This runs down, runs back up into resistance, bounces off. So more than likely, we're headed below. Okay. We do head below, and guess what? It starts trying to bounce on resistance again. Now this becomes support right here. So what we're doing is we're either waiting for this thing to head on down here and then head on up, or we're waiting for this thing to break and violate the resistance. But I'll tell you what, at this time of day, I don't even care. I got one step. That's one bounce off of resistance. Okay. All right. We got that big rejection right there. I want to circle that. Big rejection right there. Bounces off of resistance multiple times. Won't go past that swing high. It's below swing low. I got 1 bounce, 2 bounce, 3 bounce, and then another drop. So that's 1, 2, 3, 4 stairs. That's plenty. 3 is good for me. 4 is just magnanimous. But the thing is, though, is that I'm looking for a reversal. Okay, everybody else might not be looking for a reversal, and you can see that the reversal wants to get in here. Now, look, this thing was the swing low, so there was a lot of buyers there, right? That's why this volume bar is up that high on this bar. That bar right there, this price bar is the same as this one, but look, the volume's even lower. Why? Traders just aren't there at that time of day. And we've been away from the E-money line for quite a while. You know, the pivots have been pivoting quite away from the E-money line and the VWAP line. It's just been down there for too long. You got to take profits. There ain't going to be no more fuel to keep on going. I mean, unless the news is really, really bad and this is just one of those bearish sell-off days, you're just not going to have a top to bottom, you know, step after step after step all the way into the close where it closes. The market closes at the very low. Okay. But that's what happened here. In fact, I don't anticipate those kinds of days. I can trade those kinds of days all the way, but most people like me are out and we're doing other kind of work. We already got paid. It's just that the likelihood of business being that great is unlikely, so we don't get in the habit of it. You know, before when I was training and I was coming up, I would trade the full days because I needed the practice. I had to read these things, I had to learn these things and get used to seeing what's back there behind there and, you know, figure out everything. Now I've got it all figured out, and basically I just kind of like I shave off what's not profitable. So it'd be like kind of like a business that that isn't seeing business after 9 o'clock, right? I mean, there's other businesses open at 9 o'clock, but we're not seeing a lot of business after 9. So we don't employ anybody, you know, to keep the shop open. I mean, there might be a couple customers sometimes, but it's not enough. So that's just how it is for me. You know, I can't do this 24/7. And also, I actually trade in the morning. I trade all this right here. Right? So that's actually quite a while. So we get a bounce. Now this is resistance, right? What is that? Oh. So that's resistance. It tries to break through, and then it gets slammed out here. Now in this closing area, I don't like to hang out here unless I see like the kind of trade that I can trade it with, and I don't have to work very hard on it. But generally, when you get close to the close, it becomes very volatile. So unless you got a mem meter from anyone like Top Step or Mr. Top Step. He's called Mr. Top Step. Unless you got a mem from somebody, you can actually ask him. Just go on Twitter and ask him, or somebody else has already asked him. Basically, he just tells everybody what it is anyway. But I would actually keep an eye on it. If I was trading into the close, I keep an eye on the mem. That's usually the last hour, especially the last 30 minutes. I never ever violate the last 30 minutes. Unless it's just one of those days. Like all the clouds are gone, the sun's dead center. Alright? You know? The other guy's unarmed. You know, things are whistling Dixie or whatever. And so, it's just very volatile at the end of the day. Very unpredictable. Okay. So this was it for me right here about this time. Basically, the premise is that once a market has made so much of a move across this chart, and it's done enough of these legs, it's going to start looking the other direction. Okay, so then you start to anticipate that. All right, so trade accordingly. But if you trade a two-sided trade, that may not make much of a difference to you, but then again, it probably will. Oh, and the divergence. Okay, so what does divergence means? It means that two things that go together suddenly start pairing each other and going against each other. And basically, we've got price running down. We've got MACD down here running down. Keep this in mind right here. You got the 34 EMA. You got the VWAP here. And then you've got 5, 13, 1 on the MACD. Now the MACD and the MACD histogram are two different things. Let me show you something. Here are my indicators. I've got this is always on. Open interest is always on for some reason. I don't know why. I can take it off. It doesn't show up on the daily, on the intraday charts. It shows up on the daily charts. And basically, it just, the open interest shows you when contract rollovers are coming. And it helps you remember to roll over the contracts if you're holding long positions, when to change the contract so you're not trading in expired contracts. But here's the VWAP and here's my 34 EMA. They're both on the price part of the chart. Okay. Then I've got the volume. I've got that thing so it's on the chart and it's not separate, so it's not taking up a bunch of room. I want more room. I want these bars to be exaggerated as much as possible so I'm reading the language right. It's kind of like clear speaking. I want these bars to speak to me clearly. Right? So I don't have a separate area for volume. Just throw the volume on the chart. Good. Now, right here I've got the MACD and the MACD histogram in the same area. So you see this little arrow right here? So if I add, let's say anything, I don't care, CCI. All right. So I've got a lower area and a lower area, and there's the empty one, so I could add more. But basically what I can do is, here, I'll apply it. Viola, there's the CCI. Okay. MACD is basically the same. I think it's more effective at telling me MACD volume delta ratio than CCI. I think CCI is better probably for daily charts, not intraday charts. Although some people use them. They've been effective at times for me, but then they give up and they don't work. So I just stopped using them. Now I can adjust this thing so that it's in this area right here, right? With the MACD and the MACD histogram. That's two different indicators. This line is the MACD. It's normally two lines, by the way. But because I've got this thing set at 5, 13, and 1, right, which is what you need to set yours to so you don't take extra useless information. Information changes your moods, right? The information from those two lines is not going to tell you what you need to know. It'll tell you what you don't need to know, and then it'll mess up your trades. You'll read things wrong. Okay, 5, 13, 1 right there. That's the secret recipe. So just remember it, write it down or something, and then save it. You can save these things. Look, I've got all these sets. This particular one is, I believe it's the Slam set. Okay, so basically all I got to do is save here. I named the set. I've got all the same deals on there except for that CCI. I give it a name, and then I know exactly, you know, what I need for a particular strategy. Put those up there. I don't have to diddle around, you know, separate indicators, especially each time. I could just trade whole sets at a time. Okay. And the thing here is what I want to show you is that, see that CCI goes right on top of that MACD area, my area for MACD. All right. So you can combine these indicators. Okay. I can take this VWAP and move it on down. Let's see what happens there. Nothing. Let's move it on down again. If I can move it down. There we go. So now I put the VWAP down here in the MACD area. Now that's confusing, right? But as you can see, I can fit everything in these areas. Now I can put, now look, there's no VWAP up here, so I can take my VWAP, I can put it back, right back up there with my 34 EMA. I can move my 34 EMA around if I want. I just keep it on the chart because it doesn't mess me up and I need the room. Okay, apply, Viola, it's back on the chart. I can drop the CCI out of the MACD area. Why not just get rid of it because I don't use it? It's gone. Now this is cleared up. I can, well, I'm not, I don't think I'm going to mess with it, but basically what I can do is I can actually get these things to separate, so I can separate them. I just need to put one in the lower area, but I've got to delete one first and then add it down here in this other area. Then they're separated. Okay, but I keep them together so I can save, you know, space. And, you know, another thing, if they're in the same space, I can save time. I don't have to move my eyes around. You know, a lot of times for me, it's a fast-moving process. It's like fencing or sword fighting. I need to keep my eyes open. I can't be, you know, in the dark with everything spread all over the place. You know, so small areas. If I can keep everything in small areas, the smaller the area, the faster my eyes can move, grab data. You know, and I'm looking at all these other charts and other indicators and things like that too. So, you know, when the heat's on and everything's flying, you know, I don't want things spread around and I don't want things confusing. So that's why I keep these two together. All right, so let's cancel that. I'll show you something else. So this little gear right here opens up the chart settings. Chart settings. These are going to give you, I can overlap volume. So on the general tab right here, there's one, it's called the overlap volume. If I don't check that, Viola volume gets its own space, but like I said, I need these bars, these candlesticks to talk to me. And you know, I'm used to the volume bars being up here and talking to me, not down here and talking to me. These are very quiet to me. They're whispering. I want them to speak clearly. Right? I also need to save space. I want these MACDs to be a little bit bigger. I need them to speak clearly as well. So I'm going to give them some more room. I'm going to give these candlesticks some more room. And I want these volume bars to speak. There we go. Then I've got... a lot of times, I don't know why, but for some reason the charts pop up and I've got percentages over here on the right. So it tells me how many percentage points the chart has moved overall, right? So this thing is like 4450 or whatever right here. So it would tell me what percentage of 4450 this thing has moved. There's another one called logarithmic, which deals kind of in a percentage-wise, kind of a percentage basis. A lot of hedge fund investors, they use the logarithmic pricing, which is even weirder. If you're a hedge fund and you're old-timey, you just understand all this stuff, it'll click to you. But here's the price axis tab, and basically I can click this, and it'll show me price as percentage. So there's your percentages. You know what? This thing must be as daily percentages. Right? Let's see here. Let's figure it out. I thought it was like the full price of the entire market or the stock or however, whatever, but maybe it's just the day. So 0, perhaps right there. No, hold on. 0 probably would be, well, it's not going to work now. Oh. Let's see here. Zero would be the close over here, right? But oh no, but this is all negative. Maybe it has to do with this over here. So where is 0 on this thing? I don't know. I don't use it. I could figure out how to use it. You don't have to use it. If you need it like that, that's good. Go ahead. That's how you get to it. Back to the gear right here, next to the little beaker, the little chemical beaker for the indicators, right? The studies. You got studies, strategies. Then you got your indicator and strategy sets that you custom build. Okay. Then you got the settings here, the chart settings. Price axis, I don't use the price percentage, I just use the price. Okay. But for some reason, you know, it pops up like a percentage, so I've got to switch it back sometimes. I don't know what the deal is. All I know is it's a free platform. I'm not complaining. It's fairly sophisticated if I need it or use it. Time axis, not really going to use those. Not going to use this. The appearance. Basically, this is going to change your colors. So this one right here is what I use. This thing automatically comes with the preset color. So all the volume bars are going to be blue. And there you go, they're blue, but they aren't talking to me. I look at more than just volume size. I need to be glancing at this. I need to see red and green. Right? I gotta see streaks. Are they red streaks or green streaks? I gotta have as much, data here as possible without getting cluttery. Okay, so the picture's gotta be in color, right? More data, more color. All right, there we go. So we've got color. Yeah, and then up here I can adjust the types of bars. These little dudes right here, I don't worry about this the right keyer thing. It does show you opens and closes, but this stick right in the middle is not enough data to me. I think that these bars like this right here, right, where I can see the traffic, right. Otherwise, these things kind of sneaky to me. And if they're sneaky, they're not, they can sneak up on me. I'm not going to get as much data. I like data, like I say. So, I don't use those. Let's see here. There's the line. Everybody knows the line. Equivolume. That's a very interesting one. Okay, so basically, you can see the height on the volume here. Notice the volume is still the same height. Okay. On this particular day, the chart was just moving enough that the handles were 10 cents a piece. And you can see the volume comes up the same height. But as the volume comes up higher, the bars become thicker. Okay. And I call it the exaggerated volume bars. But that's not what they're called. They're actually called equivolume bars. That's been handy for me in learning where does the market start to go home and stop trading. So basically, on a day here, So here's the opener right here. I'll put a big line right there. That marks the open. Okay. Pretty wide bars, right? So plenty of volume. And then look what happens right here. So that's 2.5 hours into the trading day. What always happens at about 2.5 hours into the trading day on the S&P 500 E-mini? The trading dwindles down, and so it becomes very obvious because now these are piddly little bars and they're all bunched together. So it's like, you know, over here it was like 5, 10, 15. You got all this space just for 15 minutes. But in that same amount of space, we've got 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60 minutes, a whole hour fit into the same area where 15 minutes could only fit in before. Right? So it just teaches you that volume is dwindling off at that time. So when volume dwindles off, basically that means that unless long-term institutional traders are trying to fill positions, either selling or buying, okay, and they're going to be filling those things in mass for the rest of the day, then basically where the volume dwindles off, it's going to become very easy for the regular traders to go ahead and start controlling the market. And you can read when they're controlling it, you know what to expect. It's just like the crowd. You know, the crowd knows, okay, what do we do now? That's what we're going to do, and we do it. Okay. Now, when the big institutions get in there and get involved and they go against the trend, so we get dwindly little volume here, but what happened? Well, this thing sold right off, right? Keeps on selling off, so obviously there's some liquidation out of the hedge funds, right? Which is a message to us that we can expect lower prices, because if they're selling at the top, then we're looking lower, right? They're not looking higher. They aren't buying, so they're not looking higher. So those are, you know, the time of day is important, right? The amount of volume at the time of day is important. Keep those in mind. This is a good chart to learn, you know, what time of day does volume usually dwindle off. This is a kind of a bad day for you. Normally, if the market was bearish, when the volume starts to dwindle off, it becomes bullish again. Or if the market was bullish and the volume dwindles off, it becomes bearish. It turns around. You get a reversal. I don't mean like it's like gonna just start going lower than and make new lows, or it's going to go higher and make new highs. I don't mean that at all. What I mean though is that the volume has dwindled away and there's no more gas to keep pushing prices lower or higher. And therefore, it becomes easy to go the other direction, right? It becomes easy to force people out of the positions that they're in, right? If the market was bearish, then volume dwindles off. Usually that means that people are in short. Computers are in short. So what do you got to do to get them to get out of those positions and hit the other button, the buy button? You have to push them backwards. If you push them backwards, they get to a stop, then they hit the stops, they buy to cover. Well, that's buying on the market, so then you get a short squeeze, right? You get momentum the other direction. That's what happened here. That's what this bar is, a short squeeze. Okay, so that's what we do with the dwindly volume. If we just go in the opposite direction, that's how you can tell there's a reversal. Okay, and then you get back to equilibrium on the 34 EMA, and then you see what it's going to do, you know. Normally at that time where it reverses, then it gets back to the EMA. For me, that's about the end of the day for me during the trading session there, because it's just going to be so piddly. And the thing is that it becomes that much. It can be predictable, but it becomes that much more predictable. Where size traders, you know, they're up there playing with millions and hundreds of millions of dollars all together. You know, the whole floor of these executive buildings, and they're all over Chicago and New York and wherever. Okay, and they're trading all these these brokers' money. They borrow money. They're dealing. You know, they're basically brokering cash to these traders, and they can start swinging heavy size in those illiquid markets and get those markets to move. That's unpredictable. When the volume's very thick, they can't do that. All they can do is go along with it. That's fairly predictable. Okay. Now they can work it together. If they get together and they're going the same way anyway, then you just read that and you go, okay, well, if that's the way they're going and it starts going that way, it's not going the other way. Right? So that's, and the reason why it's not going the other way, since there's so much volume there, what that's telling me is that this is a good investment, right? The trend is good. But when it gets into the piddly volume area, right, I don't know if it's going to keep on going or not. I'm not really sure. So that's not a good investment to me, right? So I would rather not be breaking even and be messing around trying to keep what I made, and I would rather just take what I made and go. So I don't invest in the piddly part of the day, right? Just because it's so much easier to control, except for the reversal. The cup and the handle always comes through. Almost always. Let's see here. That was appearance. I need the candlestick bars, normal bars. Yeah, I don't like that hollow bar. I like the filled bar. Let's see here. Yeah, candle trend. That's the one I like. Or is it the same thing? Did I miss something here? Oh wow, they are the same. Well, whatever. I was on that one, so okay. So I was thinking I wanted these bars filled. On some charts they're filled. On these ones they're not. Okay. Cup and handle. Okay, this is a late trender. This thing's trending down quite a ways, and then it just kind of peters out and then falls off. There's no cup and handle here, really. There's not a cup and handle upside down, cup and handle up here. Head and shoulders, that's a big one. Basically, head and shoulders means that you got a price that comes up here. This is one shoulder. You got a head right here in the middle. It comes up the highest point. And it drops back down to support. It bounces up again. Normally the shoulder nearest present time is lower. So the right shoulder is usually lower than the left shoulder. Okay? And then this is the neckline. This is that support line is the neckline. Once it falls through that, then you've broken the head and shoulders. You can kind of see this thing coming, and I don't really think of this one as head and shoulders. I just think of it as like depth of market action and resistance and support, quick tails and volume bars. But that's one you'll hear out there. And so basically what I told you about this one is why the head and shoulders works. That works also on the daily chart, very common. And there's a whole reason why they work. There's the reverse head and shoulders. Let's see here. Let's see if I can find a reverse head and shoulders. Where's a good one at? Well, basically it's the exact opposite of this. Where'd it go? Here it is. No, it's not. Where's my head and shoulders? That is it, right there. Ridiculous, huh? Well, you can rewind. Oh, there it is. Okay, that was dumb. Um, so just think of it the opposite way. So basically, price comes down, it bounces off resistance, comes down, gets past the last low, it goes down past the last low, but it can't stay down there. Travels back up to the original neckline resistance up here, and then it doesn't even bounce off of the low over here. Right? So down, up, bounce, down, past this low, back up to the resistance, down, and then on through. That's a reverse head and shoulders, and basically what you're doing is you're waiting here at the neckline. Now, if you're a short-term trader, you probably don't use it quite like that all the time. You would go to the daily charts. And if you're doing options and swing trading and that kind of thing, they can kind of give you an idea of what's what's in the works. What are other traders seeing? Let's see if I can find one here. I guess not. Maybe in another market. I don't want to make this thing too long. I don't want to make this all drawn out. Let's see if I missed anything on these charts. Okay, so trends. You see trends. They actually follow those sometimes. This is not following a good trend right here. But basically, sometimes... oh, here's one. So they're following that right there. So basically what you do is you draw your line down there. Where they break the trend, the crowd is starting to think bullishly or in the opposite direction. If they haven't broken it yet and they've been sticking by it for quite a while, then basically that's telling people, hey, this is really bearish. Right? This isn't even ranging or anything. They aren't giving bulls any chances. This is going to drop, and then it usually does take a real big drop. Right? You've got this trend right here. It's trending down, and then finally it just, keeled over, and they fell off. Everybody jumped on top of the bandwagon and pushed it on down. So that's how the trend works, and basically all you're doing is talking about lower highs. Each of these tops of these 5-minute bars is a high. Each of these bottoms of these 5-minute bars is a low. And it's like that on the 15, the 30, the 2, the 1, the hour, the 4-hour, the daily, the weekly, the monthly, the yearly, the quarterly. Okay, so if you are getting higher lows, that's indicating that things are reversing. If you are getting lower highs, that's indicating things are reversing. Okay. And so it's just saying that the prices here, you can see, let's say this to this. Now I'm drawing a right angle. So here's a horizontal line, here's a vertical line. That is a right angle. And basically what that means is that that all these prices, they are about to get left behind. If they were interesting to anybody, it would indicate that this is not interesting down here. If they were interesting to anybody, it would indicate that this is interesting to somebody up here. So we are losing interest in all this area right here. If you look at it on this dome, it just says all these prices are not interesting. Let me take that off. All these prices are not interesting. If you're looking at this dome, it's just saying that all these prices up here are not interesting. Therefore, the prices are getting more and more interesting lower, and therefore they are looking to make money lower. Nobody's interested in making money higher. It's just not working. So, and basically, it's because of macroeconomic deals for the most part. That's the big mover. If they aren't seeing it in the future, at the business level out there around the world, and all the businesses, the economy and everything, and then the economy and the markets is going to read that and go along with that. if they aren't seeing that out there, then it's not going to show up on the charts. Okay? And if it's not showing up on the charts, then the economy in this industry, this trading industry, is not going to go in that direction. We're just going to follow our own economics. Now, the thing is, though, is that not always are the long-term investors going to control the dialogue here. They're not always going to control the whole thing. They're actually going to wait for the day traders, the short-term traders, to control things for them. And so what happens is you get some bullishness here, you gap up, and then what they do, the long-termers do, is they start taking profits up here. They don't get out of all of their position, but they get out of some because their position made a profit. So you just take a profit. That's how you do it, right? If you profit on something, you want to realize it and put it into something else that has dipped down, but it's a safe investment, either by the charts, by the macroeconomic indicators, by the businesses' earnings reports, by the industry, the industry sector, by their economics in there, cultural trends, political trends, yada yada, weather trends. So they make a profit. Now the thing is, they're going to take a profit. When they start taking a profit, that adds to the selling, and then the rest of the traders, eventually, right? Looks like we got some more profits here. Got a bounce here. Okay, so the rest of the traders are going to take a sign, and so we're going to actually start to sell down. All right. So when they sell and take profits, and they are not buying anymore. Now look at this. We can tell this. We can look at our whatever kind of volume delta indicator that we use. I use this MACD, the histogram, and the 13.1 exponential MACD line combined. Just trying to reiterate that for you. So I use that. So what's this telling me? That basically bullishness is not beating bearishness. Price is headed up, right? We've got price headed up. Let's see if that's a line. Yeah, that's a line. Okay. And basically the MACD is headed down. That's a divergence, right? So you got dropping here. You got rising here. It's automatic. That's a negative divergence. Why is it a negative divergence? Negative indicates that price is going up, but the delta, the bullish ratio in the volume delta, is going down, right? So bullishness is still there, but the amount of bulls is gone. It's losing. They're losing wind. The strong crane that was lifting this price up is turning into a toy, and at some point everybody knows it, and then it shears off, right? Like a toy. I mean, it's not going to hold up any weight, so they shear it off. So then, of course, you get, obviously the bears overpower the bulls. The ratio, the delta ratio in the volume, is much stronger in the bears' favor. So therefore, it turns red, right? So right here where the ratio flips to being majority bulls, you can see it turns red. Where it turns back to bears. Where it turns green here, you can see where it turns bulls again, right? Bulls on top. Sorry, I've been speaking all day. My tongue is so worn out. I should practice. Okay, so then we get down to lower prices. Now, we got long-term investors that were interested over here. They get a sale. You have to understand that they were taking profits all along here. Yeah, we'll just take profits. We're not going to buy anymore. That's the point. Look, we're not buying anymore. You guys bring the price down, okay? So us day traders and swing traders, we start to accumulate short positions. We become more and more bearish. Finally, we do wind up forcing it to sell off. We push and we push and we push until those long-term investors say, okay. Now, we know when they say okay because we see this right here. Look at this quick tail right here. This is a daily chart, by the way, on the S&P 500 E-mini futures, front month. Okay, so we see that quick tail. We see a lot of volume in that reversal. That's a pivot right there. We also see that the MACD, the whatever kind of delta volume indicator you use, is starting to climb again, showing that it's becoming more and more bullish as opposed to bearish. Okay, and then so basically you see the trend up, yada yada yada. You got shorts in there. They got to cover, right? You got people seeing that they're covering. They jump in long. You got long-term investors knowing where this is going. So they jump in long, and they're just going to do the same thing they did over here and over here. And they expect this thing not to stop right here, but they'll sure take profits when it gets there. And they'll find out if their long-term buddies in the industry want to keep taking it higher. They don't care. They're going to take profits right here. And that's why these bars become shorter and shorter. Now, this is a breakout point. What happens when you break out? Short squeeze. Right? What happens when you short squeeze? Bullish, right? Everybody buys a short squeeze because bears can't do anything about it. We're going higher, right? Because they're losing money if they don't. And so what do? We break out over the resistance, then we test and bounce. We get a quick tail right there. See that? That's a quick moving tail on that day. It tested that support, ran from it. Didn't stay down there, but they sure tested. And then you got a higher low right there. Why? Because these prices right here, they ain't selling shorties. Otherwise, if they were, we'd be looking down here, but they sure didn't. Instead, we sold all of these in that area. All this area was people buying bullies, right? So they're trying to stock up on bullies and go even higher. That's what's in. That's what's trending. That's what's hot at the mall. Wall Street is like a mall. You just got to understand what's hot and what's not. Don't get caught with what's not hot. Okay? You know, another thing while I'm on the subject, basically, you know, some stocks are more popular than others just because of their name or what they sell or something like that. Not because they're the best. They got the best books, right? The company's financial books are the best. They're in the best industry. Sometimes it's just very popular, and so the more popular they are with traders in Wall Street, it's like a hot kind of shirt or a new clothing fashion. They like those shares. Okay, so they all trade in there. Therefore, that stock is a lot more liquid. If it's a lot more liquid, it stands to go a lot higher, a lot bigger percentages. So if you got a hot stock, because Wall Street says it's hot, not because the financial books are actually great or not. It's just hot. Therefore, it stands to go even higher and higher. When they're hot, they're more liquid. When they're more liquid, the bigger hedge funds offer those markets more money because they can make more money in those liquid markets. More money has to fit in those prices. You can only fit in so much money per handle. So more money per handle means it's got to go somewhere, and if it's a hot market, it's obviously bullish. I mean, if it was bearish, it wouldn't be a hot market. So where's it got to go? It's like a balloon, right? So the balloon starts down here, then it gets bigger and bigger and bigger as more and more money goes in there and then stays in there because they see how liquid and hot that particular market is, that particular stock. Okay, so remember that. Right? You got to figure out what's hot and what's not, and you'll get more price swing. You'll make more money because what do you want to do? If you're an amateur or you're minor league, then basically you just want to see big swings. You know, you're not interested in dividends or bond appreciation. You're just interested in price swings. And so where do you go? Where the market tells you to go. Look for the liquidity. The liquidity is what's hot. And just understand that, you know, Facebook and Netflix is just going to be a hot thing. Google and Amazon is going to be a hot thing because those are in. Kellogg's cereal and Coca-Cola, General Mills and IBM is boring. They're not going to be hot. IBM and Intel used to be hot. They really used to be hot, but now they're not. Okay? They just aren't. Just kind of think about, like, what would hipsters want to wear? Would they want to wear an FB shirt? Or would they want to wear, a Studley General Mills shirt? Bowling alleys. They had, when that was hot, right? They had stocks on those. Those were hot stocks, and then they weren't. Radio Shack had a really hot stock. Airlines, when they invented the jet airplane, right? Those were hot for a long time, and then they were not. So just know what's in at the time being, and that's where the liquidity is going to be, and that's where you're going to get your biggest price swings. And if you know how to trade defensively, you can profit on big drops, and you can profit on big hikes upward either way. And that's where you're going to make the most, where they're spiking and they're dropping the most. Back to this chart. All right, so where we're at is long-term investors rely on short-term investors to give them lower prices. So right here, long-term investors, they take profits. But you know what? Short-term investors, they're like, hey, if this thing's going to continue to keep on going, I'm going with it. I'm not in here like for weeks or days at a time, or maybe I'm just in here for weeks and days at a time. So those people that are in here for, like, they bought this, right? They're a swing trader. They hold right here all the way up to here. Once they get up to here, they sell it. They look for another one, another reversal, one of these bounces, okay? And they'll just hold up to the top, up to the resistance, then they get out. Then they look for something else. They might look back here and say, oh, look, this is a quick tail. This bounced off of support, right? This is support line now. So go ahead and buy right here, right? This is all the signal I need. Okay, they watch that day. It doesn't break this line. It doesn't go any lower. They go ahead and buy it. It's actually going to break out right here. This is a resistance line. They see that it's coming. They go ahead and invest in it, or they invest right up in here. They get this, right? And so, but the thing is, though, is this has ran quite a ways. What happens when a market runs quite a ways? You got a lot of profit takers, right? If you got a lot of profit takers, you got a lot of momentum the other way. So if you got a lot of people that are holding long and they've profited, right? What's the opposite thing they got to do? They got to sell. If you got a lot of short sellers that are holding short, what's the opposite thing they got to do? They got to buy to cover. And that's why you expect these things to run for a while and then take a break and then fall down. Or run down for a while, then take a break and then fall up. Okay? It's just basic market physics, mechanics. It's like its own world, right? Gravity works up and gravity works down. You just have to know. If you're up already, then gravity's working down. If you're down already, then gravity's working up. And the longer it takes for it to reverse in the other direction, right, the more assured you can be about a movement in the other direction, and the higher or lower that it has gone, right? So the more oversold that this becomes, right, the bigger the movement in the other direction it can be. It can be. Right? But if it's really, people are really negative, you're oversold and people are really negative, then, it may not go up all the way. And that's what you're looking for. You're trying to read the crowd here. If you're really overbought, right, and everybody's still kind of bullish, right, then you're not expecting a really big drop off, right? But it could be, and that's what you're looking for. And those are indicators of, like, what's the sentiment? What's the mood of these markets? Okay. So what do you got right here? You got a doji. This is a doji. What a doji is basically the market it opened and closed right about the same place. It usually indicates a reversal is coming. Okay. That's what you start looking for. Okay, if that sign's on the chart, whether a daily chart or intraday chart or whatever, other people are seeing that. That's the thing you got to read charts like. You got to read these charts like other people saw that. That's the sign on there. Now you got to see if it's going to come true. You got to see where they test it. If the test worked or it didn't work. Okay? So this indicates a top. It did move up higher. We actually did get another breakthrough here. It looks like we kind of broke through and then it didn't really stay up there, right? Right here, this was support. We broke through a little bit. Sure didn't stay down there. We got a higher low right here and a quick tail, right? Can't even stay down there. Can't get back down there. Oh, we tried 2 more times. We can't stay down there. The market will not close down there, right? So quick tail, higher low. What's it going to be the next day? It's going to try up there. But look, lo and behold, it won't stay up there. Okay. So basically, if we range in here and then it breaks through here, that's a head and shoulders essentially. That's a reversal. How low it goes, who knows? You got to stay tuned. Watch as the movie rolls out. Very interesting. Okay. Now, same thing though here, you know. Long-termers make some money. They stop buying. Short-termers start slamming the thing down until the long-termers say, hey, we're buying right here. We know. Okay, we can see. So, well, this one right here really told you. Look how long this long tail is. Sheesh. I don't know what happened there. Oh, wait, that's Trump's election. Yeah, overnight after he won the election, the East... And, you know, who knows, whoever else, the CNN babies or whatever, all right. You know, they start selling because they were like, oh, God, the end of the world, ah! So, you know, real Western capitalists saw those prices down here and their eyes lit up. So they actually dumped billions of dollars. Like, I know Carl Icahn, who's very westernized capitalist, conservative, he's not like a harebrained or anything, you know, he dumped like $1 billion in there on this market, on the S&P 500 E-mini. So anyway, the signal is that we're buying for long term. You know, we get up here, we take some profits. They expect that. They take some profits. We try to slam it down, you know, but they got to scoop these prices up. Notice it's not touching the 34 EMA. It's riding higher. That's bullish. If it touched it, that's less bullish. If it broke through it, that's really weak. And if it stays down there, then obviously it's bearish. But it floats above the 34 EMA, so that's a bullish indicator. And we didn't get a big sell-off here, so, you know, buyers stepped in. Now they buy again, they run it up here, they take some profits, they don't buy anymore. What do? We're going to sell, right? We're going to sell. Slam, slam, slam. That's what we do. Short sell. Get out of our positions. It's not going up any higher. Let's get this thing down, right? Then they see the prices are down, they step in, they take it back up again. And so it's like a teeter-totter, like one of those little train dealies back in the old day where you got a feller on one side and a feller on the other side. They got handles on both sides and they pump up and down, right? So one feller's pushing down, the cart goes, the other feller's, you know, he's getting ready to push down, the handle comes up for him, and then he slams down. The other feller gets the handle right up to him, right up to his chin, and then he pushes down on it, and it's just back and forth. We're waiting for each other to pop it up in our direction. Now, in a bearish market, which usually lasts about 2 years, okay, once every 10 years or 15 years, okay, it's the exact opposite. You flip everything the exact other way, right? So all of these little bumps up and these dips down, you just flip over the other way. And so it's like the trend is going down, but the bumps, the dips are up, right? And so basically it's sell. You know, those hedge funds and everything, they get higher prices. So if we push prices up, right, then what are they going to do? They're going to invest in some more short selling. They're also going to liquidate some more of their holdings and keep the price going down. Right? So when they're ready, right, they'll tell us. They'll come in full force. They'll start forcing it down. That's when we'll jump on top and we'll force it down with them. Okay? And then they take profits, and then we're going to push it back up because they're not going to sell anymore. They're going to hold on. They're going to wait for higher prices so they can sell at higher prices, so they can short sell at higher prices. Sure, there's going to be a short squeeze. The short squeeze is when short sellers have to buy to cover. There's just not enough supply on the offers. The price overruns the offers. We rocket on back up. Prices get higher. You know, we're all long, right? We're all jumping on that short squeeze. It's like a no-brainer. You know, bears can't beat us. They got to join us. Finally, it all peters out. The long-termers say, we're going to sell some more right here. We're going to short sell too. Okay, we're going to join right along with you. And the train just keeps on going down and down and down. And then finally, the macroeconomics and all the economics things in the news start panning out. The companies start doing better, and it finally bounces on the bottom. It stops staircasing down lower, you know, through support, bouncing off of a resistance, back through support again, lower, bouncing off resistance and staircasing down or whatever. You know, finally it levels off. You get a cup at the bottom. You get you know, you get the kind of double bottom. You get a upside down head and shoulders. You get a T, cup, and handle, right? And you can read all those things, and you can see it in the volume. You can see the pivot volume. You can see the quick tails on it, etc., etc. And you know that the reverse is about to come along. If you want to wait and be sure, just let it go and form the handle or the right shoulder, and wait for it to get through the resistance and break out through where the top of the handle on that cup and handle is. Or it's the same thing. The right shoulder on the reverse upside down head and shoulders, that right shoulder is the handle on the cup and handle. Virtually the same thing. Okay. And so you can wait for it to break out. But if you're even more savvy, then you can actually buy the bottom of the cup. Okay. Is there anything else? Ranges. Yeah, there's a way to trade ranges. To me, trends are too good to be true. Okay, that's just how that is to me. Okay, because more times than not, the market is in a range, not in a trend. Okay, so they are too good to be true. And so once a market starts ranging, I just take it as it's going to be in a range, because more often it's in a range than it is not. And so what I'll start doing is I'll start playing long and short at the same time. So I'm capturing the bounces off the resistance and the support in both directions. Also, I've got a focus trade. I think that the thing can keep on trending in a direction. So I'm just more biased to one direction. Okay. And so every time it bounces and it comes back, and it bounces and it comes back, basically I'm getting in higher and higher. So, you know, like right here, if price came up to here, okay, and I'm bearish, right? So, you know, I might, let's say I sell short right here because it broke through. This is kind of a really thin bias right here. This is really the better bias right here. But I'm trying to show you how I can get in at a better position as this thing ranges. Okay, so this thing breaks through, and I'm like, yeah, that looks kind of bearish to me. I think I'm going to take my chances going that way. Plus this deal up here, I got this really decent quick wick up here. It's saying, you know, things going to head on down. I don't think we're going higher. Plus, I know the macroeconomics, they aren't really so jazzy. So, so I get in short down here, right? Well, this is kind of low. I want a higher position. I don't want a position right here. I want a position up here. So price moves up, and then what do? I give it another contract or another piece, right? So if I'm 1033 contracts short right here, and I move up here, maybe I add another 10 or 33, whatever, however, you know, if I break my account into 3 pieces, I'm going to add another piece, and I double up. Normally, the lowest I go is I break my account into 3 pieces, or the amount allotted to my day trading. You know, if you're new at this, you're the one that's listening to this. So if you're new, 3 contracts. That's where you start. I mean, I spent a few years learning that. And so you short one right here. Now you got a position up here. Well, you short it again, grab it. Now, if it breaks through, it's going to stop you out. You gotta stop order right above here, because if it breaks through, you don't, if it comes back, okay, you'll get short again, right? Because it's just going to go, and then, you'll wipe out that little loss. And I'll tell you how not to make a loss. But basically, you put your stop order right there, and then you're out, right? You're not short anymore. You're going to see what's going to happen here. And then you would wait for it to go up, then bounce here, right? You want to bounce on support now and then go up. So you'd start picking on that support. And then you put your stop down here. Okay? And the thing is, though, is that when price is right here, what if it doesn't go through? But it's close. This is really a better price. So you double up, or you just add more, or whatever. And now your position's up higher. Your short position's up higher, right? And so that way, when the price range is down here, okay, then what do? You take profits on that move. So you enter here, then you position here, and then technically right here, you just exit the first position in the same position. So you really haven't made anything technically, okay? But your position's over here. If you close out the whole position, you don't make anything on this trade, but you make something on this trade, right? It's actually 2 parts to the trade. So contract 1, short here. Contract 2, short here. Contract 1 gets dumped out right here at break even, and I'm holding a profit right here. Now, if market backs up and then breaks through resistance, guess what? I got all this profit. So I can even lose like 5 ticks or 6 ticks or 8 ticks or however you do it. I wouldn't recommend on the S&P 500 E-mini less than 4 ticks. I would go for 6 or 8 ticks. That might affect you a little bit, though. These days, you might have to have more money than 30,000 and 3 contracts, which is where the firms always start you out at. You might want to try oil, CL, gold, GC, the Euro, 6E, and maybe some other ones. But those are the real big liquid ones. So anyway, so I got this profit right here. And if the thing runs back, you know what? I'm not losing anything. Technically, I don't have this profit. Now, hopefully you can hold on to that thought, because what I'm going to do is I'm going to move you to a really good range. So this ain't a bad range, I guess. I guess this would be our support right here. We'll make this one, because that quick, real big quick wicks like that, normally the top is somewhere lower. It's not quite there, just because there was so much opposite wind than whatever took that thing up there. So the price, I usually work somewhere down here, like right in here, or right on the bars around it, the top of those bars, or if it's bearish, then the other way around. Alright, and this ain't the greatest one either, but basically I'm going to go long here. So basically when it came down here, well, you see this right here. We got bullishness right here. Then it jumps up there. I'm expecting to go long. So I'm in long right here. I'm holding the long one. Okay. Profit runs up there. Now, let's see, how many ticks is that? That's 8 ticks right there. So on a trade like that, I'm probably going to take profits. Right? That's probably what happened here too. They took profits, right? So if you're holding all the way through here and you got price all the way up there, they took profits. There just wasn't enough buyers to keep it going, so it petered on down here. Anyway, plus it's probably some long-term business. You can see there's a lot of volume right here, so it looks like sellers were really greedy right there. So it probably wasn't just profit takers from all this. But the thing is, though, is now my long's gone. Okay. If I was holding a lot of longs, a lot of pieces, I might just take off some and take some profits. But I'm definitely going to take some profits because I've already got that in the basket, right? And this pretty big move right here kind of signals that maybe I ought to keep on going up. But you know what? This thing says that maybe I ought to not. So after that, I'm kind of like not thinking about going any higher. So I've still got a long on. I took one off or whatever. I'm holding along now. Let's add another here. Okay, make some, right? This is 4 ticks right here. I'll take that. That's 4 ticks on the S&P 500. I'll take that. It's different on other markets. I'll take different amounts. 6 ticks, 8 ticks, 10 ticks. It depends on how fast I make it too. But 4 ticks, in a mediocre, look at these bars, they're fairly mediocre. Okay, I might not even wait to get all the way up here. Okay, so I'll take those profits. Now, if I lose on anything, I got my stop down here. If I lose on that, then that covers that. And sure enough, it did break support, so it did hit my stops, right? And then, so now I'm out, and then it actually does pop back up here. Well, it hits this. I see this little, it tries down there, and then it runs up here, and then it runs down here, and it runs up there. I'm going to buy this. Now I'm in the middle of the range, though. So now things run up here, okay? If I've got enough pieces on there, I might take profits. If I'm just doing 3 contracts, I'm still holding on. I'm waiting for it to continue on. I'm waiting for this to come up, and then bounce on support, and then head on up. This is also getting late in the day, so I don't have high hopes. So the thing bounces. Now, once it gets up here, what I'll do, I'll have a short trade on the other side. So I've got 2 domes going on. So I actually short this thing, and I just try to grab 4 ticks or 6 ticks or whatever it'll give me, however fast it'll give me. The faster it'll drop here, the more ticks I'll take. I want to guarantee myself maybe 3, but I definitely don't want to lose on it because then it starts wearing out my profits. So I grab that opposite trade, and then it's down here. Now I got this double bounce right here. Look at this. It hit, it come up, it come up right there where it opens, then it comes down again. It hit twice here, so that's a double bounce. Well, that's telling me I need to buy this, so I buy another one. Okay, so now I've got what? I bought one. Where did I buy one? I bought one right around here. Okay, halfway up. I bought another one halfway up. So when it comes up here, I take profits on. Actually, what I'll do is I've got my focus trade, which is long, on one side, on my left side, the left dome, and then on the right dome, I've got my basically my giblet picker, where I'm actually trying to catch some of these moves in the opposite direction, and I can keep on catching those as price bounces off resistance, or it bounces off support if the thing is working the other way. But I want to make as many of those short little, those short little nugget pickers to make up the difference for any losses. And what they wind up doing is they actually make up for, more than enough to cover any losses on my focus trade. Okay, so it winds up being a profitable business on the short term. And I'll show you how I do that with the ATMs on the domes. Now, so I got a contract from right here in the middle of the range. I got another contract from right here in the middle of the range. It won't even go down there. I'm going to take my chances and buy it. And then it comes up here. I'm going to sell one. So what did I do? What I did was you could say I sold this one and I took the profit right there, or I sold this one, which profited from right there to right there. But either way, if I'm holding one contract now, or one piece right here, effectively my theoretical average, or my theoretical entry, is down here, right? Even though the entries were right here, if you add them up, I took profits on one, and then you add them up, well, this half was taking profit on, right? And so if you add that down to here, that actually theoretically moves my entry down to here. And if I do that over and over and over, I keep on I keep on adding a contract or adding a piece, then I take profit on it, and then I add another piece. Like maybe it comes down to here, I want to grab it, or it comes down halfway, I want to grab it. Okay, and then so that means that my theoretical entry moves from here to here to here to here to here to here. So now it requires price to fall all the way down here before I even break even and then start losing. But I'm not even going to stay in a position that long. I'll just pull the I'll just pull out. I'll throw it overboard. Once I hit those stops, I'm out. I'm done with that. If I don't see the action going my way, I know the crowd is not interested in continuing to go my direction. But like I said, I trade a two-sided trade too. So I'm going to get in short too. So as soon as we break right here, I'm in short. I'm going to try to capture any short. I'm going to get out of the long position. I'm going to try to capture any short. And then how I do that depends on the day. In the early part of the day, I'll do it differently than I do in the middle of the day. Okay, so... And then we break through here. We get up here. There's that quick wick right there. I'm going to capture, well, that's a $2 move on the S&P 500 E-mini futures contracts. $2 move is good for me. I'm day trading, right? So I'm just going to capture that. That's $100 per contract. That's good, right? That's good enough. You know, if you're doing on average $200 or $300 a day, you're doing swell. That's not the most you can make by far with 3 contracts as your limit. The way the firms limit you, but that's average. That's pretty good, right? So at the end of the year, you'll be profitable. That'll even out any bad days or whatever. But you really shouldn't be having bad days. Eventually, you're just having good days if you're working hard. But if you're doing other things at the same time, it's kind of hard to do that. So I take a profit right there, and then I'm going to see what's happening, and look at this. They actually obeyed this. So it poked out there. You got a quick wick right there. That's telling me there's a little bit of reversal there. All right, we've got sellers up there that are interested again. We got too far in their territory. So we bounce off, and what am I doing? I'm actually looking for a bounce. Hold on. I'm looking for a bounce off of this top right here. I'm looking for a bounce and then continue higher, but it's not going to do it. It breaks through. So my stop right here below this support line, and I justify that support line by this node higher. The stop knocks me out, so now I'm looking short. And then it comes down here. Where is it going to bounce? I would suspect that it would bounce right here, but in fact it bounces off of this one. So it actually violates this one. It also violates this one. If you want to, you actually might want to consider that one more. Yeah. So effectively, what I do is that, geez, how have I been talking so long? Effectively, can't just leave. I got to get all the way through this. Effectively, well, the most effective indicator on the chart is the last one you've seen. So, way before is not as effective as the one closer to your time, right? So whatever's newer is stronger. It means more. Okay, so just remember that. But when you're talking about double tops and that kind of thing, long before can mean a lot. Now look at this. This is a double top. Topped, came down, tested, topped. Let's see if it sold off. Nope. Poked out a little bit, but didn't really go anywhere. So this is a triple top. And then what did it do the next day? Well, it sold off. Yeah. So, yeah, I was right about this. It wasn't just profit takers right there. That was kind of unusual. With that high volume and that quick wick right there. That's basically a doji. Showed me there was a lot of sellers trying to get out of positions, out of stocks. Okay. And then it sold off the next day. Here's a doji. Ton of volume. Didn't go nowhere. But that's the closing bell, so that's like right at the close. All right. So basically, what I'm saying is that I got two domes. Okay. These are different markets, but they'll suffice. Um, Hold on, I'm gonna have a drink of coffee. Holy smoke! I've been talking all day on this thing. So this is two markets on this thing, but you know what? Let's just keep you like in the zone. I know you've been hanging on to this for a long time, so you're probably getting like starting to tense and maybe wearing thin. All right, so this is both S&P 500 E-mini, same contract as this chart. So if I'm bullish on the chart, right, then I've got a focus trade. My focus trade is over here on the left dome. And then I've got counter action over here on the right dome, so that I'm going to trade counter to whatever my focus trade is. If I'm bearish on the trade, then my counter trades over here, my giblet pickers, like I'm going to eat, all those giblets off of the cob in those ranges, right? Let me show you. I know it sounds corny. T. So if I'm expecting a range, basically you've got these up and down bars. I want to take advantage of those and get all those giblets. Right? Sometimes you get better ranges than this. Sometimes it's like, okay, you got a resistance line here, you got a support line here, and the thing is just trending up and down, up and down, up and down, over and over for like a couple hours, or it's like one bar is hitting the top, the next bar is hitting the bottom, the next bar is hitting the top, the next bar is hitting the bottom. Well, that's price movement. If I can just grab a couple ticks of each one of those moves, then that adds up. That adds up. I can in this amount of time right here, I can add up 20 ticks. Can add up sometimes 30, 50. Okay? Now that adds up. It depends on what market you're in. This is $12.50 per tick. So, 20 ticks times $12.50. It's 240 50 cents, 240 about $250 or so. That's all right? I mean, on one contract, just in and out. Okay. So if you're bullish and your focus trade on the left, doesn't pan out, it doesn't work. Well, you've already stacked up so many giblets that, hey, that's all right. If you're bearish and it doesn't pan out, then you're stacking giblets on the long side, right? You're going the opposite way of your focus trade. Okay. And so you're stacking up so much that it counters any kind of losses on your focus trade, and actually surpasses the losses on your focus trade, so it becomes a profitable business on the side. Okay. And let's see how this works. Now, if I'm right here and I buy kind of high, if I buy a long contract kind of high, what I want to do is I want to work my position down. So if the market gives me a lower price, then I'll buy right here. I'll add another piece. And then when it gets back up here, I'm going to take one of the pieces off. I'm going to take profits on that piece. Now my position is entered right here. Okay. So therefore, I can only lose this amount of ticks where it bumps off my stop, right? Instead of losing all of this, right? So this is probably where support is. So if it breaks through support by 2 or 5 ticks or whatever I've got going on, then those 2 or 5 ticks that I'm losing, it doesn't make any difference to me, right? Compared to 10 ticks, right? That's going to make a big difference. That actually will ruin your day. then I'll do that over and over and over. Now, if it bumps off of resistance again and it comes back down to support, I'm going to pick up another piece right before it gets to support. So I can only move a couple of ticks down and then lose a couple of ticks. But if I'm right, and most of the time I'm right, because most of the time the chart is ranging, then it's just going to move me back up. And then I'm going to take profits on another one. So then I'm actually going to profit on this one. Now my theoretical range is right down here at support. It's way down here. And if I can do that over and over again, it just keeps on getting lower and lower. So this thing actually has to run against me so far before it actually gets me, but I won't even stay in it. You know, those are as good as gold. Over here on the counter side, what I'm going to do is, every time it gives me some room and it goes up, what I'm going to do is I'm going to short sell it, so that if it's bouncing on the resistance up here, so resistance is about right up here, then I've got to stop just on the other side of the line. Now, if it crosses the line, then it was a bad deal, but more than likely it's going to bounce, because most of the time the thing's going to range. So I'll just go down here and grab 4 ticks or whatever. I'm not greedy. I don't care if it goes all the way. I just don't care. All I care about is I got something in my basket here, my fish are in there. Why not just capture it, right? If it goes all the way down here, okay, but it's going to be a rarer instance. I'm taking more risk, and how often will it just reverse on you? Well, you could have had that if you didn't wait, but you were waiting for more, and while you're down here waiting, then you know, in your imagination you're waiting there, but really it doesn't go down there, it just reverses, then you lose the thing, right? So then you're constantly losing money. You could be gaining. And these little, 3 ticks, 4 ticks, 6 ticks, 3 or 4 is pretty good usually. They add up. You can add up 20 ticks just in a couple of tries, and market ranges all the time. So, and then that helps counter everything over here, and it also builds up everything, otherwise. So you've got 2 different trade strategies here. All right, and then the last one is that's defensive trading, by the way. Right, so you're countering your costs, you're covering your costs, you're funding one trade with another strategy, okay? So that way, if it loses, then you don't pay anything. So you're funding it rather than it just losing and then starting over. That costs you, right? So learn to fund yourself. You gotta save money. You gotta cut cost in order to make money. Remember that in business, there's 2 feet on the duck. There's 2 paddle feet on the duck, right? One is going to save, the other one's going to make. So you've always got to paddle with one in order to keep the other one straight, and so you're going in your own direction. If you don't know how to paddle with the one that's saving and the one that's defensive, right, it's hedging and so forth, right, then you've just got one leg, and what happens is you're going to find that you spin round and round in circles. Right, because you'll make some, and then you'll lose it again, and then you'll make some, and then you'll lose it again, right? And if you do this in your normal day-to-day budget in your personal life, right, you're always earning a coupon. You're always looking for a better deal. Instead of buying new things, if you're buying drones or motorcycles or RVs or guitars or mixing boards, look out there on the eBay, look on the Craigslist, look on these used sites and see where people are getting rid of recreational things, because what happens with recreational things? Everybody wants one, but guess what? Life comes into play, and then the bills come due, and they can't be playing around. And here you are, you want to do something, business-like, so what do? You get a better deal on it, and the thing works great. I mean, by the time you break 9 of the things, you could have bought a new one, but there's no way you're going to break 9 of them, so it's a good deal either way. Right? So therefore, you are earning money, right? So instead of spending the rest of the money on the new one, right? Why not just save the money? It's just as good. Nobody knows any difference. And if they do, have a good time. Listen to the mixer. Listen, listen to it in the RV. Look at this nice new bike. Here is a drone for your present. You know what I mean? Nobody cares. Nobody knows any difference. They're just as good as new. That is new. So I'm not a snob. I'm not a prim. I'm a business person. And people out there, they want to get out of those positions. They want to put their money on something else for some other reason, for some reason. And that's how I invested in a computer. My computer system setup would cost $3,000. Well, I got into one for $700 because I learned how to build it. I took a little more time and looked around while I was working. And then, I just picked up deals here where they were going out of business. They were selling monitors. Why not get those things from them? $10 a piece instead of $50 to $100 a piece. Geez, no brainer. The computer, it was a Gamester's computer. They get these big rigs. They just play video games on them. Well, that's a lot of power I can use for business, right? It's a business implement, right? I mean, if you're out there playing with dump trucks on the racetrack, but you didn't even get to race with it, you can't even figure out how to fix it or whatever, you're giving me a good deal, I'll take it. I'll fix it. All I had to do was wipe off the RAM cards, right? All I had to do was wipe them off with a little bit of rubbing alcohol and some napkins, put them back in. Viola, the thing was like brand new. And this was a computer technician. He couldn't even do it. So I saved tons of money on that system, tons of money on the monitors and wires and so on and so forth. I bought new, but if I can save it, why not? And a lot of times you're better off buying used. So if you want an off-road vehicle, don't go buy new, buy used. Usually what happens is these off-roading guys, they got all kinds of things on their rig that are gonna help you out there on the terrain, right? You're gonna be able to do more. You're gonna be able to protect yourself more from breakdowns and so on and so forth. Just have the thing checked out, tuned up. Do a pressure test on the cylinders. See if the motor's all good. If it ain't, just swap another one in there. No big deal. I mean, find one that's used and. Those older ones, they don't have so much wires and junk, so it's easy to do. That's what you need anyway. And then it's all equipped with all these gizmos and gadgets, so you're saving $10,000 on just gizmos and gadgets. $20,000, and what are you going to go do with it? You're going to go wreck it. So, you see what I'm saying? So that alone, the saving part, the hedging against risk, insuring against risk, countering the trade with an opposite trade in another market, or short in the same market, or if you are short or you're bearish, then counter it with a long position. Okay, then you're insured. It doesn't even matter how wrong you are, right? Because you're insured, right? So then that's where your other ducky paddle is keeping you in the direction that you want to go, rather than spinning around in circles, because the costs and the losses keep taken away from your gains. Go out of business faster that way, right? You're not even going to be able to buy as much stuff and time off because you got to work harder, you got to work longer, right? You're going to be more frustrated, you're going to be more stressed out. Okay, so now the last part of the strategy deals a lot with that kind of cost-cutting, defensive against risk. And so what do I do here? I think a good example is maybe the opening bell on something, or let's go back to that oil market. There was a report, inventory report today. That's a good example. Okay, now keep in mind on this particular chart that basically the more that the chart moves, they scrunch up the handles over here. So it's normally 10 cents per handle. In the after hours though, right here, right, look, it's 2 cents per handle. It's just because it's not moving very far. Okay, so the more movement you get, the more they're going to scrunch up these handles. So each handle over here on the right side, see on the right side, okay, each handle over here is worth 20 cents. Okay, so these lines right here are handles that are worth 20 cents. That's a pretty big move. Two of them is a really great move. And basically you got your seven, well, for me it's 7:30, but you got your 7:30 market here. In Eastern time zone, that is a 10:30 report. In Central time, 9:30 Mountain time. Did I get that right? 7:30, 9:30, yeah, 8:30. 8:30 in the Mountain time. You already know. Okay, so report comes out. Now, what am I gonna do? I'm gonna trade both sides here. Okay. What always happens? Well, the thing runs up and then it runs down. So I want to capture both directions. So what do? I've got a long order and a short order. On my long side, I profit on the one dome on the left. So what do? I grab those profits. As soon as it starts telling me, hey, we're not going anywhere further, and I've already got it already in the basket, right? The fish are in there. I'm going to close the door and just call that one done. Now I'm going to look at the other one. Okay, so this is the thing though. I'm short at the same time. Price up here. If price starts talking to me up here, I'm going to add another short. Okay. Otherwise, I'm gonna look for it down here. Okay. And so what I'll do is, if price breaks out of this, it's going to trigger another long because I need to hedge my short position. You understand? So that way I'm not losing anything on my right side dome, right? That's where I'm short. Okay. And so when I'm hedged here, it can go in any direction. I'm not making or losing any money until I start reading the chart and then letting one go, keeping the other one going. Okay. And so basically though, the thing does not break out. It didn't trigger my long order, so I'm just short. Now, I'm profitable on this one already. I've captured that. Okay. My short is a loss. It's a losing trade. So basically I'm neutral right here. Okay. But knowing these things, they jolt up and down, or they jolt down and up. That's just how they are, these reports. And it's like that in the morning, you know, the opening bells. It's boom, bang, bang, boom. Okay. It's the best time to use this strategy. Okay. So then the thing, you know, I entered right here, the thing drops down here, and then it profits. Okay. Right. So I capture profit once it starts saying, you know, I mean, geez, guys, 20 ticks per contract. It's quite a bit. Okay. So I mean that, you know, I wouldn't even have to get 20 ticks before I'd capture it. And so I get out on that one. That one's closed. I'm done with it. Now I'm looking for another one. Okay. So let's say that I go ahead and do another one here. I'm not even going to trade the range. I'm just going to do the same thing. Which way am I going? I don't know yet. But we've got quick wick right here. I'm gonna pick short. We got a lower high right here. We got a quick wick right there. I'm going short. So, but that's my focus trade. And then what I'm gonna do is I'm gonna hedge it with a long trade, but not yet. Okay. So I go short, and then I'm right. All right. So you can kind of see how that goes. Once I start bouncing, I'm gonna look for the counter trade. All right. I can pick giblets. If that ain't doing so well, then I'll just pick giblets. If it's actually going to run the other way and start running the other way pretty well, then maybe I'll just let it long. There's two different strategies. There's the giblet picker, and then there's the long and the short way running both ways. And I'm going to show you how to do both. You already kind of got the giblet thing where you pick off the ranges there and you just focus on one focus trade until it goes the other way. All right, and then you're going to base those on your steps, right? Where it's bouncing on support, where it's bouncing on resistance, and that kind of thing. Okay, so, but here I'm doing a long and a short deal. So what I'm doing here is, let's say I'm long. and then this thing breaks through. It pulls me long. Now I've got a short order right here, so if it breaks through support, it's going to knock me in short. Okay, and then it runs down. Okay, so when it gets down here, right, it's telling me that this thing's not running, so I'm going to go ahead and take profits on it. And then I'm still long, right? So basically I haven't lost anything, right? Because I captured this area right here and I'm long. Okay. Now I can wait and see it's ranging here, right? And then this I can kind of short, right? And then I'm right? And then I capture that short. Okay. But is it going to run the other way? I don't know. At some point, though, what I'm doing is I'm looking to add another long, though. The thing is, though, is if I get in short because I see it bouncing off of this resistance, boom, boom, boom. Well, it looks like it's ranging to me, so I'm going to get in short here, right? Because this thing may continue on down. This is a trend, right? It looks like it's headed on down to me. I mean, this is the swing low, and we're bouncing right on it, right? This is the opening swing low. It's the lowest point in the morning. And so now we're bouncing on that resistance. Where's it going to go? Probably on down. But the thing is, though, is I was long. I'm looking for a position to go long. So I'm going to stick with that. And that's okay. Now, we bounce off of this resistance. Bounce off this resistance. I capture 10 more ticks here. Easy. Okay. Do I get in on another long position? Not on this. I don't see where it's going down long enough. I would get in on a position down somewhere down here, you know. And then all of this is telling me that I don't get into another long position until I'm down here. But the thing is, it doesn't even matter that the long position is losing because I'm capturing all of the downward move, which means that I haven't been wrong yet, but I haven't been very right yet. Okay. The thing is, though, is that I captured this short move here, and then, you know, I'm going to capture it again. I get in short again up here, let it run, I capture it right there, you know, and I'm long from here to here now, but I'm capturing the short move, I'm capturing the short move, I'm capturing the short move. Where do I get out of the short move? I take profits wherever it starts to tell me that they're going to give up. Okay. And then I see it ranging here. This is resistance, so it's telling me it's ranging here. So wherever it's going to range, it's resistance, I'm going to get in short again. That's a pretty good place to get short to counter my other trade. Now if this reverses, then I flip the script and I start doing the exact opposite thing. If it's gonna flip the script, what it does, it starts bouncing on support. If it starts bouncing off of support, then that first time it bounces off support, that means it's not going any lower. I want to grab another long and then capture some of this on the way up. Every time it goes up, I take a profit. It bounces off of support. Okay, I add another one, and then I take a profit as it goes up, and just step by step by step.